Hello and welcome. Every year, over 150 million Americans sit down to perform a civic ritual, filing their federal income tax return. Whether you do it yourself with software or work with a seasoned tax professional, you gather your documents, fill out the forms, and hit submit. A small sense of relief follows. The task is done for another year. But have you ever paused to wonder what happens next? What happens in the moments, days, and weeks after your return vanishes into the vast digital system of the Internal Revenue Service, or IRS? Does a person in a quiet office somewhere immediately pull up your Form 1040 and start scrutinizing every line? Is it all just stored away unless you get unlucky? The reality is far more complex, automated, and in many ways more fascinating than most people imagine. In this series, we are going to pull back the curtain on one of the most fundamental and least understood processes of our financial lives: how the IRS actually verifies your tax information. Our goal is not to tell you how to do your taxes, nor is it to provide any form of financial or legal advice. Instead, our purpose is purely educational. We want to demystify the system, to help you understand the mechanisms that work silently in the background to ensure the integrity of the United States tax system. Disclaimer: before we proceed, it is essential to state this clearly. The information provided in this entire series is for educational and informational purposes only. It is not a substitute for professional tax, legal, or financial advice. Tax laws are complex and subject to change, and your individual circumstances are unique. Always consult with a qualified professional, such as a certified public accountant or a tax attorney, for advice tailored to your specific situation. So with that crucial understanding in place, let's begin. The U.S. tax system is built on a principle called voluntary compliance. This term can be a bit misleading. It doesn't mean that paying taxes is optional. It means the system trusts you, the taxpayer, to report your income and deductions honestly and accurately in the first instance. You voluntarily calculate and pay what you believe you owe. But for this system to work, there has to be a robust method of verification. If there were no checks and balances, the entire framework would crumble. This is where the IRS's verification process comes in. Its primary job is to ensure that the voluntary part of the system is upheld with fairness and accuracy, making sure everyone pays their fair share. The first thing to understand is that the IRS is not manually reviewing every single tax return that comes in. With hundreds of millions of returns filed each year, that would be an impossible task. Instead, the first line of verification is a massive, sophisticated, and highly automated computer system. Think of it as a silent guardian, constantly scanning and cross-referencing information. This system's most powerful tool is something called information matching. The IRS doesn't just rely on the numbers you provide on your tax return. It also collects vast amounts of financial data from third parties, the people and institutions who paid you money throughout the year. Have you ever received a W-2 form from your employer? That form details your wages, salary, and the taxes that were withheld. When your employer sends a copy to you, they also send an identical copy directly to the IRS. Similarly, if you have a savings account that earned interest, your bank will send you a Form 1099 INT. Guess what? They also send that same information to the IRS. If you sold stocks, your brokerage firm sends a Form 1099-B. If you did freelance work for a client, and they paid you more than $600, you'll likely receive a Form 1099 NEC. In each case, a copy goes straight to the IRS. This creates a vast web of interconnected data. When you file your tax return, the IRS's computers perform a critical task. They match the income you reported with the income that third parties reported paying you. Let's imagine a simple scenario. Your W-2 says your employer paid you $60,000. Your bank's 1099 INT says you earned $100 in interest. You file your tax return and report $60,000 in wages, but you forget to include the $100 in interest. The IRS computer system will scan your return and compare it to the data it received. It will see the W-2 data from your employer, which matches what you reported. That's good. But it will also see the 1099 INT data from your bank. The computer will immediately flag a mismatch. The bank reported paying you $100, but your tax return doesn't show that income. This is the most common and fundamental way the IRS verifies information. It's an automated check for discrepancies between what you say and what others say about your finances. When a mismatch is found, it doesn't automatically mean you're in trouble. It often leads to an automated notice, typically a letter in the mail. This letter, often called a CP 2000 notice, will state that there appears to be a discrepancy and will propose a change to your tax liability. It gives you the opportunity to either agree with the change or provide an explanation and documentation if you believe the IRS is mistaken. This information matching program is the bedrock of IRS enforcement and compliance. It is incredibly effective at catching unintentional errors and omissions. It ensures that common types of income, like wages and bank interest, are reported accurately across the board. So while the image of an auditor with a green visor manually combing through receipts is a popular one, the reality for most taxpayers is that the first and most important check is performed silently and digitally by a computer comparing data points. This system is the reason why accuracy is so critical when you file. It's not just about what you declare. It's about ensuring what you declare aligns with the information the IRS is already receiving from countless other sources. In our next chapter, we will dive deeper into the specific types of information returns, going beyond the common W-2 and 1099s, to explore the full spectrum of data the IRS uses in this powerful matching program. We'll explore how transactions you might not even think about, like certain digital payments or real estate sales, are also reported to the IRS, painting an ever more complete financial picture that your tax return must align with. Thank you for joining us for this introduction. Understanding this foundation is the first step in demystifying the entire process and appreciating the intricate system that underpins our nation's finances. Welcome back. In our last chapter, we introduced the foundational concept of IRS verification, the automated information matching system. We learned that the IRS doesn't just take your word for it. It compares the information you report on your tax return with data sent directly to them by third parties. We touched on the most common example, the Form W-2 from your employer. But your financial life is much more than just a paycheck. It's a complex tapestry woven from savings, investments, side hustles, and major life transactions. And for almost every thread in that tapestry, there's an information return painting a picture for the IRS. Today, we're going to explore that broader digital footprint. We'll look at the specific forms that give the IRS a panoramic view of your financial activities, turning a simple sketch into a detailed portrait. As always, a reminder: this content is for educational purposes only and is not tax, legal, or financial advice. For guidance on your specific situation, please consult a qualified professional. Let's start with an area that touches millions of Americans: investment income. Perhaps the simplest form here is the Form 1099 INT, which we mentioned briefly last time. If you have a savings account, a certificate of deposit, or certain bonds, any financial institution that pays you more than $10 in interest is required to send both you and the IRS a 1099 INT. It's a straightforward report of interest income earned. Things get a little more involved with Form 1099 DIV. The DIV stands for dividends. If you own stocks or mutual funds, the companies or fund managers may distribute a portion of their earnings to you as dividends. This form details those payments. The IRS's matching system checks to see if the dividend income you report on your return matches the total from all the 1099 DIVs they have on file for you. It's important to note that even if you automatically reinvest your dividends to buy more shares, that is still considered taxable income for that year and is reported to the IRS. Now let's talk about the other side of investing: selling. This is where Form 1099 becomes in. The B stands for broker. Whenever you sell stocks, bonds, mutual funds, or other securities through a brokerage account, your broker is required to file Form 1099-B. This form reports the details of the sale, most importantly the gross proceeds. This is a critical point. The form tells the IRS the total amount of money you received from a sale. The IRS computer sees this transaction. It is then the taxpayer's responsibility to report their cost basis, what they originally paid for the asset, on their tax return. The difference between the sale price and the cost basis is the capital gain or loss. The matching system is particularly powerful here because it can see the sale occurred. If a 1099-B is filed but no corresponding sale is reported on your tax return, it can be an immediate red flag for the system. Next, let's move into a rapidly growing area of our economy: the world of digital payments and the gig economy. The key document here is Form 1099-K, payment card and third-party network transactions. If you sell items online through a marketplace like eBay or Etsy, drive for a ride-sharing service like Uber, or receive payments for goods or services through a platform like PayPal or Venmo, you may receive a 1099-K. These third-party payment networks are required to report the gross amount of payments they process on your behalf to the IRS once you cross certain thresholds. It's crucial to understand that the amount on a 1099K is the gross, unadjusted total of transactions. It doesn't account for expenses, returns, or fees. It also doesn't distinguish between a business sale and a personal transaction, like getting paid back by a friend for dinner. The IRS system sees the gross income figure. It is the taxpayer's responsibility to maintain good records to accurately report their net business income and separate any personal transactions that are not taxable. The rise of Form 1099K has given the IRS unprecedented visibility into the gig and online seller economy. The government itself is also a source of information. If you received unemployment benefits, you'll get a Form 1099G. G is for government. State agencies report all unemployment compensation to the IRS because it is generally considered taxable income. This same form is also used to report state or local income tax refunds. This can sometimes be a surprise. The general principle is that if you claimed a deduction for paying your state taxes on your federal return one year, a refund of some of that tax in the next year may be considered taxable income. The 1099G provides the raw data for the IRS matching system to check. Finally, the IRS's digital footprint extends to major life transactions. If you sell your home, the transaction is typically reported on Form 1099-S, proceeds from real estate transactions. The closing agent, such as a title company or an attorney, is responsible for filing this form, which reports the gross proceeds from the sale. Just like with stock sales, the IRS knows the transaction occurred. The taxpayer then reports the sale on their return, applying their cost basis and any eligible exclusions, like the main home sale exclusion, to determine if any tax is owed. And information flows both ways, not just for income, but for major deductions too. If you have a home loan, your mortgage lender will send you Form 1098, Mortgage Interest Statement. This form reports the amount of mortgage interest and points you paid during the year. When you claim the mortgage interest deduction on your tax return, the IRS computer can compare the amount you claimed to the amount your lender reported on Form 1098. A significant discrepancy could lead to a query. As we can see, the IRS's automated verification system is fueled by a diverse and constant stream of data from all corners of your financial life. From the interest on your savings, to the sale of stock, to your online business, to the sale of your home, a digital record is being created and sent to the IRS. The system then pieces together this data to form a comprehensive financial profile, which it compares against the one you present on your tax return. In our next chapter, we will address the logical next question. What happens when the computer finds a mismatch? We will explore the process that begins when a discrepancy is flagged, and demystify the most common communication you might receive from the IRS, the automated notice. Thank you for joining us as we continue to explore the intricate workings of the tax verification system. Welcome back. In our first two chapters, we established the framework of IRS verification. We learned how a powerful automated system constantly cross-references the tax return you file against a vast web of data from third parties, like your employer, your bank, and your stockbroker. We've seen how this system creates a detailed digital footprint of your financial life. This raises the most important question of all. What happens when the computer finds a mismatch? What is the first step the IRS takes when the numbers don't align? The answer, for millions of Americans each year, arrives not as a phone call or an email, but as a physical letter in their mailbox. This is the primary tool of the automated verification system. Understanding this process is key to demystifying the IRS. Before we go further, our standard disclaimer. This information is for educational purposes only. It is not intended as tax, legal, or financial advice. Always seek the guidance of a qualified professional for your individual circumstances. Also, it's critical to know that the IRS's initial contact about a tax return issue will almost always be through the U.S. mail. Be extremely wary of unsolicited emails, texts, or phone calls claiming to be from the IRS, as they are often scams. When the IRS's automated matching program, known as the Automated Underreport or AUR program, detects a discrepancy, it generates a notice. The most common notice in this situation is the CP2000. Let's break that down. A CP2000 is officially called a Notice of Proposed Adjustment for Underpayment or Overpayment. The most important word in that title is proposed. A CP2000 is not a bill. It is not a formal audit. It is a proposal. It is the IRS's computer system essentially saying, "Hello, we see information from a third party that doesn't seem to match what's on your return. Here is our calculation of what we think the correction should be. Please review this and let us know if you agree or disagree." So, what does this notice actually look like? While the specific details will vary, a CP 2000 notice is generally structured in a clear way. It will show the tax year in question and the date the notice was sent. Most importantly, it will include a detailed section that breaks down the discrepancies it found. For each mismatch, the notice will typically show 3 columns of numbers: the amount you reported on your return, the amount the third party reported to the IRS, and the difference between the two. For example, if you forgot to report the sale of some stock, it might show $0 in the column for amount shown on return, $10,000 in the column for amount reported by payer, and a $10,000 difference. The notice will clearly identify the payer, the source of the information like ABC brokerage, and the type of form, such as a Form 1099-B. Following this breakdown, the notice will present a proposed calculation. It will show how this unreported income, or other discrepancy, would change your tax liability. It will recalculate your adjusted gross income, your taxable income, and finally, the new amount of tax. The proposal will also include any interest that has accrued from the original tax filing deadline, and potentially accuracy-related penalties. Again, this is all part of the proposal. It is not yet a final assessment. Perhaps the most important part of the CP 2000 package is the response form. This form is your channel of communication back to the IRS. It lays out your options, which generally fall into 3 main paths. Path 1 is agreement. If you review the notice, check your own records, and realize that the IRS is correct, perhaps you genuinely forgot about a 1099 form or made a simple mistake, you can check the box indicating that you agree with all of the proposed changes. You would sign the form and mail it back. The IRS would then officially adjust your account and send you a formal bill for the amount due. Path 2 is disagreement. If you review the notice and believe your original tax return is accurate, you can check the box indicating you do not agree. This path requires more than just checking a box. You must provide a signed statement explaining why you disagree and attach supporting documentation to prove your position. For example, if a Form 1099-K from a payment app included reimbursements from friends that are not taxable income, you would explain this and provide records to support your claim. If the IRS notice is about a stock sale, you might provide brokerage statements showing your cost basis, proving that your calculation of the capital gain was correct, even if the gross proceeds match their records. Path 3 is partial agreement. Sometimes the situation is mixed. You might agree with one of the proposed changes, but disagree with another. The response form allows for this as well, and again, you would need to provide a clear explanation and documentation for the items you dispute. Regardless of which path you take, there are 2 universal rules. First, do not ignore the notice. A CP 2000 typically has a 30-day response deadline. If you do not respond, the IRS will assume you agree with their proposal. They will then move forward and send a statutory notice of deficiency, which is a more formal and serious step that gives you 90 days to either pay or petition the U.S. tax court. Responding promptly is key. Second, and this may be counterintuitive, you should generally not file an amended tax return, a Form 1040-X, to correct the issue raised in a CP 2000. The CP 2000 process is a self-contained system for making these specific corrections. Sending in a separate amended return at the same time can cross signals in the IRS system, potentially creating more confusion and delaying a resolution. The best course of action is to work within the process initiated by the notice. In summary, the automated notice is the workhorse of the IRS verification system. It's a data-driven, systematic inquiry designed to resolve clear-cut discrepancies efficiently. It is not a sign of a major investigation, but rather a request for clarification. In our next chapter, we will move beyond the world of automated notices. We'll explore what can trigger a more in-depth review of your return, and discuss the different types of examinations, which people commonly refer to as tax audits. Thank you for joining us as we continue to navigate the procedures of the Internal Revenue Service. Welcome back. In our journey so far, we have explored the silent, automated world of IRS verification. We've seen how computer systems match third-party data to your return, and how discrepancies are often handled through automated notices sent by mail. But what happens when an issue is more complex, or when a tax return is flagged for a deeper review? This is where we move beyond the automated notice and into the realm of what the IRS officially calls an examination, but what everyone else knows as an audit. The word audit can cause a great deal of anxiety. It often conjures images of a stressful, invasive investigation. While any inquiry from the IRS should be taken seriously, the purpose of this chapter is to demystify the process. Our goal, as always, is to provide neutral educational information to help you understand what an audit is, how a return is selected, and the different forms an examination can take. And of course, our standard disclaimer. This content is for informational purposes only and does not constitute tax, legal, or financial advice. Please consult with a qualified professional for advice related to your specific situation. So how does the IRS decide which returns to examine? With hundreds of millions of returns filed, less than 1% are selected for an audit. The selection is not usually a matter of bad luck, it's a methodical process. The primary tool the IRS uses is a sophisticated computer program, known as the Discriminate Information Function, or DIF system. In simple terms, the DIF system scores every tax return. This score is not a judgment on your honesty, it's a statistical analysis. The program compares your return to a set of norms derived from a pool of similar returns. It looks at the relationship between the income you report, the types and amounts of deductions and credits you claim, your profession, and other factors. If a return deviates significantly from the statistical norm, it receives a higher DIF score. A high score doesn't automatically trigger an audit, but it does mean that the return is more likely to be flagged for a human reviewer to take a closer look. Another selection path is through the information matching program we've already discussed. If a CP 2000 notice is issued for a discrepancy and the issue is not resolved, or if the discrepancies are particularly large or complex, it could escalate to a full examination. Returns can also be selected through related examinations. If a taxpayer's business partner, an investor in a partnership, or an ex-spouse is audited, the IRS may decide to examine the related returns to ensure all transactions between the parties are reported consistently. Finally, some returns are chosen through third-party information or as part of a specific compliance project. The IRS may focus on a particular industry or a type of transaction where they have identified a pattern of non-compliance. A very small number of returns are also selected through a random sampling program called the National Research Program. These highly detailed audits help the IRS understand compliance trends and update the formulas for their DIF scoring system. Once a return is selected for examination, it's important to understand that not all audits are the same. They generally fall into one of three categories, ranging in scope and intensity. The most common type, by far, is the correspondence audit. As the name suggests, this entire audit is handled by mail. The IRS will send you a letter requesting specific documentation to support an item on your return. For example, they might ask for receipts for a large charitable donation, records to substantiate business expenses, or proof of eligibility for a certain tax credit. You then mail or fax copies of the requested documents back to the IRS. This type of audit is limited in scope and focused on just one or two specific issues. The next level up is the office audit. In this case, you will receive a letter asking you to come to a local IRS office on a specific date. The letter will detail the issues under examination and list the records you should bring with you. An office audit is broader than a correspondence audit and is handled by a trained tax examiner. It might cover several areas of your return, such as income from a small business or rental property. The most comprehensive and least common type of examination is the field audit. This is where an IRS revenue agent comes to you, at your home, your place of business, or your accountant's office. Field audits are typically reserved for the most complex tax returns, often involving large businesses or intricate investment activities. The agent may conduct a thorough review of your books and records and may interview you or your employees. Regardless of the type of audit, the process begins the same way, with a letter in the mail. This letter is your official notification. It will explain what tax year is being examined, what specific items are under review, and how you should proceed. The notice will also include a critical document. Publication 1. Your rights as a taxpayer. This document outlines your fundamental rights during the process, including the right to professional representation and the right to appeal any IRS decision. Understanding these different levels of examination helps to put the process in perspective. An audit is simply the IRS's method for verifying the accuracy of information that goes beyond what its automated systems can do. In our next chapter, we'll take a closer look at some of the common areas on a tax return that can draw scrutiny and become the focus of an examination, helping you understand what kind of records are important for substantiating your financial life. Thank you for joining us as we continue to shed light on the inner workings of the tax verification system. Welcome back. In our previous chapter, we demystified the process of how a tax return is selected for an examination or audit, and we outlined the different forms these examinations can take. we learned that selection is often a data-driven process, designed to flag returns that fall outside of statistical norms. This leads to a natural question. What specific areas on a tax return tend to attract this kind of scrutiny? While any line item on any return can be questioned, experience and data show that some areas are reviewed more frequently than others. The reason is usually not about suspicion, but about complexity and the need for clear documentation. Today, we're going to explore some of these common focus areas. Our goal is to understand why these items might prompt questions from the IRS. The unifying theme you will hear again and again is the absolute importance of good record keeping. As always, we must begin with our disclaimer. This information is for educational and informational purposes only, and is not a substitute for professional tax, legal, or financial advice. Your financial situation is unique, and you should always consult with a qualified professional. Let's begin with one of the most frequently examined areas: self-employment income and expenses, reported on Schedule C. The rise of the gig economy and freelance work means millions of Americans are self-employed. When you are an employee, your income is reported on a W-2, and there are limited deductions. When you are self-employed, you are responsible for reporting all of your gross income, and you are entitled to deduct the ordinary and necessary expenses you incur in running your business. This creates a significant area of potential complexity. The IRS may focus on Schedule C to verify two main things: that all income has been reported, and that all claimed expenses are legitimate business expenses, backed by proper records. Commonly reviewed business expenses include vehicle costs, meals, and travel. For example, if you use your personal car for business, the IRS would want to see that you have a contemporaneous mileage log to support your deduction, not just an estimate. For the home office deduction, there are very specific rules about exclusive and regular use that must be met and documented. The key takeaway is that the burden of proof is on the taxpayer to show that an expense was for business, not personal purposes. This is why clear, organized records are the best asset a small business owner can have. Another area that can draw attention is unusually high itemized deductions in relation to a taxpayer's income. Remember the DIF score we discussed? It's a statistical comparison. If a taxpayer's deductions are significantly higher than the average for their income level, it can raise the score. A common example is large non-cash charitable contributions. If you donate property like a car or valuable art, the IRS will want to see a proper appraisal and the correct forms to substantiate the value you claimed. Similarly, very high deductions for medical expenses or other itemized categories might prompt a letter simply asking for documentation to support the figures. It's not an accusation, it's a request for verification. Rental real estate activities reported on Schedule E are another area of focus. Like a small business, owning rental property involves both income and a wide variety of potential deductions, from mortgage interest and property taxes to repairs and depreciation. The IRS may review these returns to ensure that expenses are correctly categorized. For instance, distinguishing between a currently deductible repair, like fixing a leak, and a capital improvement that must be depreciated over many years, like replacing the entire roof. They may also verify that any personal use of the rental property by the owner has been properly accounted for, as this can limit the amount of expenses that can be deducted. Finally, certain tax credits are subject to a higher rate of review due to their complexity. The Earned Income Tax Credit, or EITC, is a prime example. This is a valuable credit designed to help low to moderate income working individuals and families. However, the rules for qualifying, especially those concerning the definition of a qualifying child, can be very intricate. Because of this complexity, the IRS is tasked by Congress to ensure a high level of accuracy, which results in more examinations for returns claiming this credit. These are often correspondence audits asking for proof of residency, relationship, and age for the qualifying children. Looking at these different areas, Schedule C businesses, high deductions, rental properties, and specific credits, reveals a clear pattern. The IRS focuses on areas where there is a greater potential for error or misinterpretation, and where the taxpayer's own records, rather than third-party data, are the primary source of information. This underscores our central theme. An audit is fundamentally a review of your records.
Disclaimer: this video is for informational and educational purposes only, and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Thorough, organized, and contemporaneous documentation is the key to substantiating the figures on your tax return. In our next chapter, we will walk through the examination process itself. What should you expect after you receive that initial audit letter? We'll discuss how to prepare, what happens during the audit, and what your options are once the examiner makes their determination. Thank you for joining us on this educational journey into the tax verification process. Welcome back. In our series so far, we have journeyed from the IRS's silent, automated verification systems all the way to the point where a tax return is selected for a direct human review, known as an examination or audit. We've discussed how returns are chosen and what common areas tend to draw focus. Now we will step into the process itself. What actually happens during an audit? What can a taxpayer expect after receiving that official letter in the mail? The goal of this chapter is to walk through the typical stages of an examination, from preparation to conclusion, to replace uncertainty with understanding. As we proceed, please remember our essential disclaimer. The information provided here is for educational purposes only. It is not tax, legal, or financial advice. For advice tailored to your unique circumstances, you should always consult with a qualified professional. The examination process officially begins with the notification letter from the IRS. This document is your roadmap. It is crucial to read it carefully, as it will specify the tax year under review, the exact items being examined, and the type of audit, whether it is a correspondence, office, or field examination. The letter will also provide instructions and a deadline for your response. The first stage for the taxpayer is preparation. This involves gathering the specific records and documents needed to support the items listed in the audit notice. For example, if the IRS is questioning your business meal expenses, you would gather your receipts, credit card statements, and records showing who you met with and the business purpose of the meeting. If the examination is about the sale of a property, you would gather the closing statements from both the purchase and the sale to substantiate your cost basis and capital gain. The key here is organization. Having your records in a clear and orderly fashion makes the entire process more efficient. It is also a best practice to send copies of your documents to the IRS and keep the originals for your records. At this stage, it is important to understand a fundamental right you have as a taxpayer: the right to representation. You are entitled to have a qualified tax professional represent you and advocate on your behalf during the audit process. These professionals, who are authorized to practice before the IRS, include certified public accountants, CPAs, enrolled agents, EAs, and tax attorneys. Your representative can help you understand the IRS's requests, organize your documentation, and communicate directly with the examiner for you. Once you are prepared, the examination itself proceeds according to its type. For a correspondence audit, the interaction is entirely by mail or fax. You will send in the requested documents, and the examiner will review them. They may send a follow-up letter if they have more questions or need more information. For an office audit, you or your representative will meet with a tax examiner at a local IRS office. During the meeting, the examiner will review your records and ask questions to gain a better understanding of your financial situation and the items reported on your return. The scope of the audit is generally limited to the items listed in the initial notification letter. For a field audit, an IRS revenue agent will conduct the examination at your place of business, your home, or your representative's office. This is the most comprehensive type of audit. The agent will review your original books and records and may ask for a tour of your business operations to better understand how your income and expenses are generated. Regardless of the type, the goal of the examiner is the same: to gather the facts, apply the relevant tax law to those facts, and determine if the tax return is accurate as filed. After the examiner has reviewed all the information, the audit will move toward one of three possible conclusions. The first outcome is a no-change audit. This means the examiner has accepted your return as it was filed and has found no reason to make any adjustments. You will receive a letter confirming that the audit is closed with no changes. The second outcome is an agreement. The examiner may propose adjustments that result in an increase in your tax liability. If, after reviewing the proposed changes and the examiner's reasoning, you agree with the findings, you will be asked to sign an agreement form. This form finalizes the changes to your tax return. The IRS will then adjust your account and send a bill for the additional tax, plus any applicable penalties and interest. The third outcome is a disagreement. If you do not agree with the examiner's proposed changes, you do not have to accept them. This is not the end of the process. A disagreement opens the door to the next stage in the tax administration system. The U.S. tax system provides taxpayers with the right to appeal the IRS's findings, first within the IRS itself, and then, if necessary, through the courts. If you disagree with the audit results, the examiner will explain your appeal rights. Your first formal step is typically to request a conference with the IRS Independent Office of Appeals. This is a crucial part of the system, designed to resolve tax disputes without the need for costly and time-consuming litigation. In our next chapter, we will take a deep dive into this very topic, the appeals process. We will explore how this independent office functions, and what a taxpayer can expect when they seek to appeal the results of an examination. Thank you for joining us as we continue to map out the tax verification and resolution process. Welcome back. In our last chapter, we navigated the audit process and reached a critical fork in the road, the moment of disagreement. We learned that when a taxpayer does not agree with the findings of an IRS examiner, the process doesn't simply end. Instead, it opens the door to a fundamental taxpayer right, the right to an appeal. Today we are going to walk through that door. We will explore the role and function of the IRS Independent Office of Appeals. This is a crucial, yet often misunderstood, part of the tax administration system, designed to resolve disputes fairly, impartially, and whenever possible, without the need for expensive and time-consuming court battles. As we begin, it's vital to remember our guiding principle. This content is for educational purposes only. It is not tax, legal, or financial advice. For guidance on your specific situation, you should always consult with a qualified professional. So what exactly is the Office of Appeals? Its mission is right there in the name. It is an independent office within the IRS. It is completely separate from the examination or collection functions that conducted the initial review of your case. This independence is the cornerstone of the entire process. The appeals officers who work here are tasked with a single goal: to resolve tax controversies in a way that is fair and impartial to both the taxpayer and the government. An appeals officer's job is not to automatically defend the auditor's position. Instead, they take a fresh, objective look at the entire case. They are trained to consider the hazards of litigation. This is a key concept. It means they evaluate the strengths and weaknesses of both sides of the argument, and assess the possibility that either the taxpayer or the government could lose if the case were to go to court. This risk analysis allows them to be more flexible, and to find middle ground that an examiner may not have been able to consider. The appeals process typically begins after an audit is completed and the taxpayer has received a letter, often called a 30-day letter, that details the proposed changes and explains the right to appeal. To formally start the process for most cases, the taxpayer or their representative must submit a formal written protest. This protest is not just a simple letter of disagreement. It is a structured document that lays out the taxpayer's case. While specifics can vary, it generally includes the taxpayer's identifying information, the tax years in question, a copy of the 30-day letter, a list of the specific findings they disagree with, and most importantly, a detailed statement of facts supporting their position, and a discussion of the law or other authority that backs up their argument. It is the taxpayer's opportunity to formally present their side of the story. Once the protest is received and processed, the case is assigned to an appeals officer, and the central event of the process is scheduled: the appeals conference. This is not a formal court hearing. It's typically an informal meeting, often held over the phone or via video conference, between the appeals officer and the taxpayer or their representative. The goal of the conference is to have an open discussion about the disputed issues. The appeals officer will have reviewed the case file from the auditor, as well as the taxpayer's written protest. They will listen to the taxpayer's arguments, ask clarifying questions, and discuss the facts and the application of the tax law. It is designed to be a collaborative and non-adversarial environment where both sides can work toward a resolution. Following the conference and a full review of the case, there are two main potential outcomes. The most common and desired outcome is a settlement. Based on the hazards of litigation, the appeals officer may propose a resolution. Sometimes they may agree fully with the taxpayer. Other times, they may propose a compromise where both sides concede certain points. If an agreement is reached, the taxpayer signs a specific form, the case is closed, and the matter is resolved. However, if a settlement cannot be reached, the appeals process concludes without an agreement. At this point, the Office of Appeals has done all it can. The IRS will then issue what is known as a statutory notice of deficiency, often called a 90-day letter. This is a very significant, legally required document. It states the IRS's final determination of the tax deficiency, and informs the taxpayer that they have 90 days from the date of the letter to take their case to the next level. filing a petition with the U.S. Tax Court. The appeals process, therefore, serves as the final and most powerful administrative remedy available to a taxpayer within the IRS. It provides a vital, impartial forum to resolve disputes before heading down the path to formal litigation. In our next chapter, we will follow that path. We will discuss what the U.S. Tax Court is and how it functions as the primary judicial forum for taxpayers who continue to dispute an IRS determination. Thank you for joining us as we continue to explore the layered and structured process of tax controversy resolution. Welcome back. In our previous chapter, we explored the IRS Independent Office of Appeals, the final administrative opportunity for a taxpayer to resolve a dispute within the IRS. We learned that if no agreement is reached, the IRS issues a statutory notice of deficiency, also known as a 90-day letter. This letter represents the IRS's final determination and starts a 90-day clock for the taxpayer to choose their next step. Today, we follow the path for those who continue to disagree with that determination. We will discuss the primary destination for these disputes, the United States Tax Court. This chapter will provide an educational overview of what the tax court is, its unique role in the U.S. legal system, and how it functions as an impartial judicial forum for resolving tax controversies. As we delve into this legal topic, our disclaimer is more important than ever. This content is for informational purposes only and is not legal or tax advice. The legal process is complex, and you should always seek counsel from a qualified attorney for advice on any legal matter. The U.S. Tax Court is a specialized federal court established by Congress. Its sole purpose is to adjudicate disputes over federal taxes. The judges of the tax court are experts in the highly complex Internal Revenue Code. This specialization is what sets it apart from other federal courts. However, its most significant feature for a taxpayer is a crucial procedural one. In most federal courts, if you have a dispute with the government, you must first pay the amount in question, and then sue for a refund. The U.S. Tax Court operates differently. It is the one judicial venue where a taxpayer can challenge a proposed tax deficiency before paying the disputed amount. This deficiency litigation is a foundational principle of the court, allowing taxpayers to have their day in court without first having to come up with the funds the IRS claims they owe. A case in tax court begins when a taxpayer files a petition in response to a notice of deficiency. This must be done within the strict 90-day period outlined in the IRS notice. This deadline is absolute and cannot be extended by the court. If the deadline is missed, the taxpayer generally forfeits their right to challenge the deficiency in tax court. The petition is a formal legal document that outlines the taxpayer's identity, the tax years in dispute, and a clear statement explaining which parts of the IRS's determination they disagree with and the facts that support their position. Recognizing that many tax disputes involve relatively small amounts and that taxpayers may not have the resources for a formal trial, Congress created a special, simplified process within the tax court. This is known as the Small Tax Case Procedure, or S-Case. Taxpayers can elect to use this procedure if the amount of disputed tax, including penalties, for any single tax year is $50,000 or less. The S-Case process is intentionally less formal. The strict rules of evidence are relaxed, and the proceedings are designed to be more accessible, allowing many taxpayers to represent themselves without a lawyer. The goal is to resolve smaller disputes more quickly and with less expense. However, there is a very important trade-off. Decisions made in S-cases are final and cannot be appealed by either the taxpayer or the IRS. For disputes over $50,000, or for taxpayers who wish to preserve their right to appeal, the case proceeds under the regular tax court rules. This is a more formal legal process. It involves stages like pleadings, discovery, where the taxpayer and the IRS's attorneys exchange information and documents, and potentially a formal trial. A tax court trial is held before a single judge, and there is no jury. At the trial, both the taxpayer, or their attorney, and an attorney from the IRS Office of Chief Counsel present their cases. They can call witnesses, submit documents into evidence, and make legal arguments. A key concept in any court case is the burden of proof. In most tax court proceedings, the IRS's determination in the notice of deficiency is presumed to be correct. This means the legal burden is generally on the taxpayer to introduce credible evidence to prove that the IRS's calculations or legal interpretations were wrong. This reality highlights the theme we've discussed throughout this series: the critical importance of maintaining thorough and accurate records. Those records often become the primary evidence used to support a taxpayer's position in court. In summary, the U.S. Tax Court stands as an independent judicial arbiter, ensuring that taxpayers have a fair and accessible forum to challenge an IRS determination before being required to pay. In our next chapter, we will shift our focus. Having explored the entire process of how tax information is verified and disputed, we will now turn to what happens after a tax liability is finalized, either by agreement, appeal, or court decision, and remains unpaid. We will begin to explore the IRS collection process. Thank you for joining us on this exploration of the American tax system. Welcome back. Over the past 8 chapters, we have followed a comprehensive journey. We've explored how the IRS verifies tax returns, what happens during an audit, how disputes are handled through the appeals process, and finally, how they can be resolved in the U.S. tax court. At the end of that journey, one thing is established: a final legally determined tax liability. Now our series pivots. We turn our attention from the determination of a tax debt to the collection of that debt. What happens when a tax bill is finalized but goes unpaid? This is where the IRS's collection function takes over. This chapter will explain the initial stages of the collection process, from the first bill to the various options available to taxpayers who cannot pay in full right away. As always, we must begin with our important disclaimer. This information is for educational purposes only, and is not a substitute for professional tax, financial, or legal advice. The IRS collection process has specific rules and procedures, and you should always consult with a qualified professional for guidance on your individual situation. The IRS collection process does not begin with a knock on the door. It begins, just like an audit, with a letter in the mail. After a tax debt is assessed, the IRS computer system will automatically generate a formal bill. This first notice is often a CP-14, Notice of Tax Due and Demand for Payment. This notice is the official starting gun for the collection process. It will clearly state the amount of tax owed for a specific tax year. It will also show any penalties and interest that have been calculated and added to the balance, and it will provide a date by which the payment is due, typically 21 days. It is a straightforward demand for payment. If the taxpayer does not pay the amount in full by the due date, the IRS will not immediately take enforcement action. Instead, the automated system will send out a series of additional notices. These letters, often designated as CP-501, CP-503, and CP-504, serve as escalating reminders. Each letter in the sequence has a progressively more urgent tone, warning of potential collection actions if the debt is not resolved. During this time, 2 things are happening to the total amount owed. Interest and penalties are accumulating. It's important to understand what these are. Interest is essentially a charge for not paying your tax debt on time. The government charges you for the use of its money from the original due date of the tax until it is paid in full. The interest rate is set by law and can be adjusted quarterly. This interest can also be applied to the penalties themselves. Penalties are additions to the tax, imposed for not complying with tax laws. The 2 most common are the failure to file penalty and the failure to pay penalty. The failure to file penalty applies when you don't file your return by the due date, while the failure to pay penalty applies when you don't pay the tax shown on the return by the due date. These penalties, combined with compounding interest, can cause a tax debt to grow significantly over time. The IRS understands that not everyone can pay a large tax debt in a single payment. Therefore, the system has several established programs to help taxpayers manage their obligations. For those who just need a little more time, a short-term payment plan may be available. This can provide up to 180 additional days to pay the liability in full. Interest and penalties still apply, but it provides some breathing room without requiring a formal long-term agreement. For those who need more time, the most common solution is an installment agreement. This is a formal agreement with the IRS to make monthly payments over time, much like a car loan. For tax debts under a certain threshold, many taxpayers can apply for an installment agreement directly on the IRS website in a matter of minutes. This allows the debt to be paid off in a manageable way. In cases of significant financial hardship, there is another option known as an offer in compromise, or OIC. An OIC is an agreement that allows a taxpayer to resolve their tax liability with the IRS for a lower amount than what they originally owed. It's important to understand that the OIC program is not for everyone. It is intended for taxpayers who are in a difficult financial situation, and for whom paying the full debt would create an economic hardship. The IRS has a strict set of criteria and a detailed application process to determine if a taxpayer is eligible. In summary, the initial phase of the collection process is a structured sequence of written notices. It is designed to inform the taxpayer of the debt and provide opportunities to resolve it through various payment options. In our next chapter, we will explore what happens when this initial phase is unsuccessful. What are the more forceful tools the IRS can use to collect a debt when a taxpayer does not respond to notices or make payment arrangements? We will discuss the federal tax lien and the levy. Thank you for joining us as we continue to break down the complexities of the U.S. tax system. Welcome back. In our last chapter, we explored the initial stages of the IRS collection process, which is characterized by a series of notices and various options for taxpayers to pay their debt over time. But what happens when those notices are ignored and no arrangements are made? What happens when a tax debt remains delinquent? This is when the IRS can move from request for payment to enforced collection. Today, we will discuss the two primary legal tools the IRS uses to collect unpaid taxes: the federal tax lien and the levy. These are serious topics, and they are often confused with one another, but they are two very distinct actions. Our goal is to explain what each one is, how it works, and the critical difference between them. As we discuss these powerful collection tools, our disclaimer is essential. This information is purely for educational purposes and is not legal, financial, or tax advice. Dealing with enforced collection actions requires careful consideration of your specific circumstances, and you should always consult with a qualified professional. Let's start with the first tool, the federal tax lien. A lien is not the seizure of your property. Rather, a lien is a legal claim the government places on your property when you have a delinquent tax debt. Think of it as the IRS securing its interest. It's a public declaration that you owe the government money, and it gives the IRS a legal right to your property before many other creditors. A statutory tax lien actually arises automatically and secretly after three conditions are met. First, the IRS assesses the tax liability. Second, it sends you a notice and demand for payment, that first bill. And third, you neglect or refuse to pay the full amount. At that moment, a lien attaches to all of your property and rights to property, including assets you acquire in the future. However, for this lien to be effective against other creditors, the IRS typically makes it public by filing a document called a Notice of Federal Tax Lien, or NFTL. This notice is filed in public records, such as with the county recorder's office where you own real estate. The filing of the NFTL is what makes the lien public. It alerts other lenders and creditors that the government has a claim on your assets. This can have significant consequences. A notice of federal tax lien can negatively impact your credit score, make it difficult to sell or refinance property, and may hinder your ability to get a loan. To summarize, a lien is a claim. It secures the debt. Now let's talk about the tool that actively collects the debt, the levy. A levy is the actual seizure of your property to satisfy an unpaid tax debt. If a lien is the claim, the levy is the taking. It is a much more aggressive collection action. However, a levy does not happen without warning. By law, before the IRS can levy your assets, it must first send you a final notice of intent to levy and notice of your right to a hearing. This is a critical legal notice. It informs you that the IRS intends to begin seizing your assets, and that you have 30 days to request a formal hearing with the IRS Office of Appeals to contest the action. This hearing is a crucial safeguard, which we will discuss in our next chapter. If you do not respond to this final notice, the IRS can proceed with the levy. The IRS can seize many different types of assets. The most common levies are against financial assets. The IRS can issue a wage garnishment, where your employer is legally required to send a portion of each of your paychecks directly to the IRS until the debt is paid. They can also levy a bank account, which is a one-time seizure of whatever funds are in the account on the day the bank receives the levy notice. Other financial assets, like retirement income or Social Security benefits, can also be levied. In addition to financial assets, the IRS has the authority to seize and sell physical property, such as your car, boat, or even your house. While the seizure of a primary residence is rare and requires court approval, it is a tool the IRS has at its disposal for significant, unresolved tax debts. It is important to know that the law does provide some protections. A certain amount of your income is exempt from a levy to provide for basic living expenses. Certain government payments and a minimal value of personal effects and tools for your trade are also protected. The key distinction to remember is this: a lien secures the government's interest in your property, while a levy actually takes that property to pay your tax debt. They are sequential steps in the enforced collection process. In our next chapter, we will focus on the important taxpayer protection built into this process. The collection due process hearing, your formal opportunity to appeal a proposed levy before it happens. Thank you for joining us for this serious but important discussion within our exploration of the U.S. tax system. Welcome back. In our last chapter, we discussed the serious enforcement tools of the IRS, the lien and the levy. We learned that while a lien is a claim against property, a levy is the actual seizure of that property. Critically, we mentioned that before the IRS can levy your assets, it must send a final notice that includes an explanation of your right to a hearing. Today, we will focus entirely on that right. This is one of the most important taxpayer protections in the entire Internal Revenue Code. It is called the Collection Due Process Hearing, or CDP hearing. This chapter will explain what this hearing is, its purpose, and how it serves as a crucial opportunity for a taxpayer to be heard before the government can take their property. As always, we must start with our disclaimer. This information is for educational purposes only and is not legal or tax advice. The CDP process involves specific legal rights and deadlines, and you should always consult with a qualified professional for guidance on your individual circumstances. The collection due process hearing is a legal right that was established to ensure fairness in the collection process. Its primary purpose is to give taxpayers a chance to have a proposed levy reviewed by an impartial party before the levy takes place. This hearing is not conducted by the collection personnel who are seeking to take the action. Instead, the case is assigned to the IRS Independent Office of Appeals, the same office that handles disputes over audit results. An impartial appeals officer will review the case from a fresh perspective. A taxpayer can request a CDP hearing after receiving certain key notices from the IRS. The most common is the final notice of intent to levy and notice of your right to a hearing. A taxpayer can also request a hearing after the IRS files a notice of federal tax lien. To request the hearing, the taxpayer must submit a written request, typically on Form 12153, within the 30-day timeframe specified in the notice. Meeting this deadline is absolutely critical to secure your formal CDP rights. So, what can a taxpayer actually discuss and accomplish during a CDP hearing? The scope is quite broad. First and foremost, the taxpayer can propose collection alternatives. This is the most common and constructive use of the hearing. Instead of allowing the levy to proceed, the taxpayer can argue for a different, less intrusive way to resolve the tax debt. This could include proposing an installment agreement with manageable monthly payments, or submitting an offer in compromise to settle the debt for a lower amount due to financial hardship. The taxpayer can also present evidence that their financial situation is so dire that they cannot afford to pay anything at the moment, and request to be placed in currently not collectible status. Second, a taxpayer can raise certain legal and procedural challenges. They can argue that the IRS did not follow the proper rules and procedures when it proposed the levy. In some situations, a spouse can also raise spousal defenses, such as an innocent spouse claim, arguing that they should not be held responsible for a tax debt created by their spouse or ex-spouse without their knowledge. Third, in very limited circumstances, a taxpayer can challenge the underlying tax liability itself. This means they can dispute the actual amount of tax the IRS says they owe. However, this is only allowed if the taxpayer did not have a prior opportunity to do so. If you received a notice of deficiency and had the chance to go to tax court after an audit, you cannot use the CDP hearing to get a second chance to argue about the amount of the tax. But if you never had that opportunity, the CDP hearing may be your first and only chance to contest the debt itself. After the taxpayer has presented their case, the appeals officer will consider all the facts and arguments. They are required to balance the government's need to collect the tax with the taxpayer's desire for a solution that is not overly intrusive. At the end of the process, the appeals officer will issue a written notice of determination. This document will explain their decision. They may decide that the levy can proceed, that it should be stopped, or that a proposed collection alternative, like an installment agreement, is the appropriate resolution.
Disclaimer: this video is for informational and educational purposes only, and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Importantly, the process doesn't necessarily end there. If the taxpayer disagrees with the determination made by the Office of Appeals, they have one final level of recourse. They have 30 days to file a petition and appeal that determination to the U.S. Tax Court. This right to judicial review ensures that the IRS's administrative decision is itself subject to oversight by the courts. In summary, the CDP hearing is a powerful safeguard, providing a formal and impartial review that acts as a critical check on the IRS's collection power, ensuring due process before property is seized. In our next chapter, we will take a closer look at the collection alternatives that are often discussed during these hearings, such as the offer in compromise and currently not collectible status. Thank you for joining us as we explore the rights and procedures that define the American tax system. Welcome back. In our last chapter, we explored the collection due process hearing, a critical right that allows taxpayers to propose alternatives before the IRS can seize their property. A central theme of that discussion was the ability to present evidence of financial hardship and suggest a more manageable way to resolve a tax debt. Today, we will take a deeper dive into two of the most significant hardship-based solutions within the IRS framework: the offer in compromise, or OIC, and being placed in currently not collectible status, often called CNC. These are formal IRS programs designed to provide a path forward for taxpayers who genuinely cannot afford to pay the full amount they owe. As we discuss these complex topics, our standard disclaimer is essential. This content is for educational purposes only and is not financial, legal, or tax advice. The eligibility and application processes for these programs are rigorous and fact-specific. Always consult with a qualified professional for guidance. Let's begin with the offer in compromise. An OIC is an agreement between a taxpayer and the IRS that settles the taxpayer's tax liabilities for less than the full amount owed. It is important to understand that this is not a program that anyone can use to simply negotiate a lower debt. It is a legitimate option only for those who meet specific criteria, and the IRS evaluates each case thoroughly. An OIC can generally be accepted for one of three reasons. The first and most common is doubt as to collectability. This means that based on a detailed analysis of the taxpayer's complete financial situation, their assets, income, and expenses, it is unlikely that the IRS would be able to collect the full amount of the tax debt before the time limit for collection expires. The second reason is doubt as to liability. This is used far less often during the collection phase, and applies only when there is a genuine dispute as to whether the tax debt was ever owed in the first place. This is typically addressed during an audit or appeal. The third reason is effective tax administration. This is for unique and compelling situations where, even if the taxpayer could technically pay the full amount, doing so would create a significant economic hardship. This might also apply if, due to exceptional circumstances, forcing collection would be considered unfair and inequitable. To apply for an OIC based on doubt as to collectability, a taxpayer must submit extensive financial documentation to the IRS. The agency will then calculate what it calls the reasonable collection potential, the amount it believes it could realistically collect from the taxpayer's assets and future income. An offer will generally not be accepted if it is less than this calculated amount. Now let's turn to the second option: currently not collectible status. CNC status is not a settlement or a reduction of the debt. Instead, it is a temporary suspension of collection activities. When the IRS places an account in CNC status, it has determined that the taxpayer's income is not enough to cover their basic, allowable living expenses and also make payments on their tax debt. Essentially, the IRS agrees to stop trying to collect for the time being. This means they will stop sending levies to your bank or employer. However, it is crucial to understand what CNC status does not do. The tax debt does not go away. Interest and penalties continue to accrue, meaning the total amount owed will keep growing. Also, if you are due a tax refund in a future year, the IRS will automatically seize that refund and apply it to your debt. CNC status is temporary. The IRS will periodically review your financial situation, typically by looking at the income reported on your annual tax filings, to see if your ability to pay has improved. If your income increases, the IRS can remove the CNC status and resume collection efforts. For many, CNC provides critical breathing room during a period of unemployment or illness, but it is not a permanent resolution in itself. Both the offer in compromise and currently not collectible status are powerful tools designed to bring fairness to the collection system when a taxpayer is facing genuine economic hardship. They demonstrate that the system has built-in mechanisms to distinguish between those who won't pay and those who truly cannot pay. In our next chapter, we will discuss an important resource for all taxpayers, especially those facing difficult problems: the Taxpayer Advocate Service, an independent organization within the IRS dedicated to ensuring that every taxpayer is treated fairly. Thank you for joining us as we continue to explore the U.S. tax system. Welcome back. Throughout this series, we have navigated the intricate and sometimes intimidating landscape of the Internal Revenue Service. We've journeyed through automated verifications, detailed examinations, appeals, and the powerful collection process. These systems, while necessary, can sometimes feel overwhelming for an individual. But what happens when the system doesn't work as it should? What if a taxpayer gets caught in a procedural loop, or faces a hardship that the standard processes aren't equipped to handle? This is where a unique organization comes into play: the Taxpayer Advocate Service, or TAS. Today, we're going to explore the mission and function of TAS, your voice at the IRS. It serves as a critical safety net, designed to protect taxpayer rights and resolve problems that can't be fixed through normal channels. As we discuss this valuable resource, please remember our standard disclaimer. This information is for educational purposes only and does not constitute legal or tax advice. For guidance on your specific situation, a qualified professional should be consulted. The Taxpayer Advocate Service is an independent organization within the IRS. That independence is its most important feature. While its employees are part of the IRS, their job is to advocate for taxpayers. Their mission is twofold. First, to provide free, personalized help to individual taxpayers who are facing significant hardship or procedural issues. And second, to identify and recommend systemic changes to the IRS to prevent problems from happening to other taxpayers in the future. So who qualifies for help from TAS? The service is not a replacement for the normal IRS customer service lines or for routine questions. Instead, it is for taxpayers who have a serious problem that they have been unable to resolve. Generally, a case will be accepted if it meets one of several criteria. First, if the taxpayer is experiencing a significant hardship. This is a broad category. It could mean an economic hardship, where an IRS action is preventing you from meeting basic living expenses like housing, food, or transportation. It can also mean you will suffer irreparable injury or long-term adverse impact if your problem isn't resolved. Second, if an IRS system or procedure is not working as it should. This can happen when a taxpayer has tried to resolve an issue through normal channels, but has gotten no response. Or if they have experienced a delay of more than 30 days past the normal processing time to resolve a problem. Third, if the taxpayer is facing an immediate threat of adverse action. For example, if the IRS has proposed a levy on a bank account that would cause extreme financial difficulty, TAS may be able to step in. If a case meets these criteria, the taxpayer is assigned a personal advocate. This advocate becomes a single point of contact who can cut through bureaucratic red tape. They have the authority to review a taxpayer's case, talk to the relevant IRS departments, and issue what is called a taxpayer assistance order, which can compel the IRS to temporarily stop a collection action, release a levy, or take other necessary steps to provide relief. The advocate's job is to ensure the taxpayer is treated fairly and their rights under the law are protected. Beyond helping with individual cases, TAS plays a crucial role in improving the tax system for everyone. The head of the organization, the National Taxpayer Advocate, delivers an annual report to the U.S. Congress. This report identifies the most serious problems taxpayers are facing and makes specific legislative and administrative recommendations to fix them. This systemic advocacy helps to address the root causes of taxpayer problems. For taxpayers who believe they qualify for assistance, the primary way to request help is by filing Form 911, Request for Taxpayer Advocate Service Assistance. There is at least one local taxpayer advocate office in every state, the District of Columbia, and Puerto Rico, ensuring that this free and confidential service is accessible nationwide. In essence, the Taxpayer Advocate Service functions as the conscience of the tax administration system, ensuring that even within a vast federal agency, the rights and individual circumstances of every taxpayer are heard and respected. In our next chapter, we will take a closer look at the foundation of this work. The Taxpayer Bill of Rights, a document that outlines the 10 fundamental rights that every taxpayer has when interacting with the IRS. Thank you for joining us on this educational journey. Welcome back. In our last chapter, we explored the Taxpayer Advocate Service, an independent office that serves as a voice for the taxpayer within the IRS. The very existence of that service is a testament to a core principle: that taxpayers have fundamental rights. Today we will explore the formal foundation for those protections, the Taxpayer Bill of Rights. While these rights have long existed in various parts of the tax code, in 2014 the IRS grouped them into 10 clear, accessible categories. The goal was to empower taxpayers by helping them understand the basic principles of fairness and justice that are supposed to govern every interaction they have with the IRS. This chapter will serve as an educational overview of these 10 crucial rights. As always, we must begin with our disclaimer. This information is for educational purposes only and is not legal or tax advice. Understanding your rights is the first step, but applying them to a specific situation may require the help of a qualified professional. The 10 rights can be thought of as a blueprint for how the U.S. tax system should operate. Let's explore them, grouped by their core themes. First is the theme of fair and just treatment. This includes 3 rights. The right to be informed means you are entitled to clear explanations of the law and IRS procedures. This right is why IRS notices, forms, and publications are meant to be understandable. Second is the right to quality service, which states that you should receive prompt, courteous, and professional assistance from the IRS. Third is the right to a fair and just tax system. This is a broad but important right, which commits the IRS to consider facts and circumstances that might affect your ability to pay or comply with the law, connecting directly to the hardship provisions we've discussed. The second theme is the right to challenge and be heard. This is the bedrock of the dispute process we've covered in detail. It includes the right to pay no more than the correct amount of tax, the most fundamental right of all. It also includes the right to challenge the IRS's position and be heard, which allows you to raise objections and provide evidence. This is then strengthened by the right to appeal an IRS decision in an independent forum. This right explicitly guarantees access to the Independent Office of Appeals and, ultimately, the courts, ensuring that you can have your case heard by an impartial party. The third theme is privacy and finality. This group of rights protects your personal information and provides certainty. The right to privacy ensures that any IRS inquiry will be no more intrusive than necessary and will respect your due process rights. This is closely related to the right to confidentiality, which is a powerful legal protection that prohibits the IRS from disclosing your tax information to others, except as authorized by law. Finally, the right to finality gives you certainty by setting time limits, known as statutes of limitation, on how long the IRS has to audit your return or collect a tax debt. The fourth and final theme is the right to representation. We have touched on this in previous chapters. This right guarantees that you can hire an authorized representative, such as a CPA, an enrolled agent, or an attorney, to represent you in your dealings with the IRS. It ensures that you do not have to face the complexities of the tax system alone. These 10 rights, grouped together, form a powerful statement. They are published in every main IRS facility and are meant to guide every action taken by every IRS employee. They serve as a constant reminder that the tax system, while complex, is built upon a foundation of fairness. Understanding these rights empowers you to navigate your tax obligations with confidence, knowing that a framework of protections is in place. In our final chapter, we will bring our entire series to a close. We will summarize the key themes we've discussed, from automated verification to taxpayer rights, and leave you with a concluding perspective on the U.S. tax system. Thank you for joining us as we explore the foundational principles of taxpayer protection. Welcome back for the final chapter in our comprehensive journey through the U.S. tax system. Over the past 14 chapters, we have traveled from the silent, digital moment a tax return is filed, through the layers of verification, examination, and appeal, and into the complex world of collection and taxpayer rights. Our goal was to pull back the curtain, to demystify the processes of the Internal Revenue Service, and to replace apprehension with understanding. In this concluding chapter, we will bring all these threads together, summarizing the key themes of our series, and offering a final, balanced perspective on the system that underpins our nation's finances. As we conclude, we offer our final disclaimer. This series was created for educational and informational purposes only. It is not and has never been a substitute for professional tax, legal, or financial advice from a qualified expert who can apply the law to your unique and specific circumstances. Looking back, we can see that the IRS verification and collection system is built on several core principles. The first is the immense power of automation and data. The entire process begins not with a human reviewer, but with a sophisticated computer network that cross-references the information you provide against a torrent of data from third parties: your employer, your bank, your broker. This information matching is the silent guardian of the system, the primary reason that accuracy on your return is so essential. The second key principle is that of a structured, sequential process. As we have learned, the IRS does not act erratically. A levy is not the first step in a collection case, it is the last. An audit is not a random event, but the result of a methodical selection process. From the initial automated notice, to the formal examination, to the right to an independent appeal, and finally to a day in court, the system follows a legally mandated progression. Understanding this sequence is key to navigating it. The third, and perhaps most important, principle is that this is a system of rights and balances. Woven throughout the procedures of examination and collection is a deep commitment to taxpayer rights. The Independent Office of Appeals provides a check on the auditor. The Collection Due Process Hearing provides a check on the collector. The Taxpayer Advocate Service acts as a safety net for the entire system. And all of these are unified under the 10 core principles of the Taxpayer Bill of Rights, which serves as the foundational promise of a fair and just system. If these principles are the threads of the system, what is the golden thread that a taxpayer can hold on to throughout? It is the one theme we have returned to again and again: the profound importance of good record keeping. Accurate, organized, and contemporaneous records are the single most powerful tool a taxpayer possesses. Good records ensure you file an accurate return in the first place, minimizing the chances of an automated notice. They are your primary evidence in an examination, allowing you to substantiate your deductions and prove your income. They are the foundation of a successful case in appeals or in tax court. They are the financial proof required to qualify for hardship provisions like an offer in compromise. More than any other single action, maintaining good records transforms you from a passive participant into an active and prepared one. It is not a guarantee that you will never be questioned, but it is the best guarantee that you will be able to answer those questions with confidence and clarity. In conclusion, the United States tax system is undeniably complex. Its enforcement powers are significant, and its reach is broad. Yet it is not an arbitrary system. It is a system governed by law, defined by procedure, and balanced by a fundamental commitment to the rights of the taxpayer. Our hope is that this series has provided you with a clear, neutral, and educational map of that system. By understanding how it works, you are better equipped to navigate it accurately and effectively. Thank you for joining us on this journey.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.